Alright, breaking news. Someone just paid $19 million to have lunch with Warren Buffett. And that makes me a little sad because for $19 million, I'll pretend to be Warren Buffett all day long. I'll give you all the secrets, like buy the dip. Alright, in all seriousness, there is a really interesting update that just recently happened in that the New York Fed just released their new prediction model about what the odds are of a recession, and the odds just went way, way up. And the second thing we're going to talk about is explore the idea if it's a good time to buy heavy into things like Bitcoin, which have hit their 4-year moving averages, as well as a little heavier into the stock market because everything's in free fall and investors are now at peak fear mode. So here are some really interesting historical statistics that might surprise you. So far this year, the stock market's S&P 500 is down 23%. Now, in an average bear market, the market goes down 34%. But we are not in an average market because our Papa Powell, the central bank man, has committed to raising rates at 0.75%. And that means the odds of the stock market acting like it did in the 70s just went way, way up. So here's what happened the last time we did this. On January 1973, the Fed started to raise rates. By September 1974, rates reached 11%. Now at the same time while that was happening, the stock market started to plummet. And by September 1974, it lost 45% of its value. So while our interest rates are going up, which the Fed has told us they're going to increase, our stock market will most likely continue to fall. Now, one of the most interesting things that also recently happened is the Fed just told us that they want an economic reset. Here's what Papa Powell just said, and I quote, "If you're a home buyer or a young person looking to buy a home, you need a bit of a reset." Those are some really strong words from the Fed that they'd want a whole economic reset for real estate, but it kind of makes sense why they'd want it because in the last 24 months, real estate has gone up 37%. That is not affordable, that is not sustainable, because by comparison, the last time we grew anywhere near this fast was in 2008, when real estate went up 29% in 24 months. So we're beating 2008, and not necessarily in a good way when you remember that incomes have only averaged roughly 6% growth in the last few years. Now, the reason that the Fed is specifically focusing on real estate is because the top 1% of the richest Americans control 53.9% of individual stocks in the US versus roughly 14% of US real estate. So real estate represents a much more broad measure of economic growth of building wealth, so it makes sense to reset for the middle class. Now, arguably one of the craziest things that just recently happened is Bitcoin did something historic that people thought for the longest time would be impossible. Bitcoin went down to $17,600, and the reason that price point is so important is because it is lower than its previous all-time high of $19,700 in 2017. So for the longest time, people thought Bitcoin would never go below its previous high of roughly 20K, but it has. And now we're here, and now people have a ton of questions about what's going on, including myself. I have questions I don't know the answer to, but hopefully as you continue watching this nerdy video, I can help explain exactly what's going on and give you a breakdown of this new prediction model about the crazy recession. So let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the weekly group therapy sessions. So first, let's talk about this new prediction model because before making this video, I had no idea this was a thing. But it's a thing, and it's the New York Fed's DSGE forecast model. And it's supposed to predict the future of what's gonna happen to the economy, and it's supposed to be used by policymakers to make better economic decisions. So that when articles come out that ask, is it a big deal that 40% of USD was printed in the last 12 months? No, it's not. Correction, yes it is. Yes it is. It's totally a big deal, and this prediction model is supposed to help with things like that. So the reason that I think it's really fascinating is because even though they say that it's unofficial, it's actually a lot more accurate and more sophisticated than their official prediction. And that's because when the Fed releases information about a recession and about inflation, they structure that data in a way that's like a magic trick. It's designed to manage your expectations because that has a big impact on how you spend your money. So this model is a lot more accurate. And here's how it works. It kind of blew my mind. It combines things like the GDP, the gross domestic product, which is a measure of how much stuff the US makes, the GDI, which is the gross domestic domestic income, like the GDP, but income related. It uses the PCE, which is not something you take to EDC with you. PCE is a measurement in the change of consumer prices. It uses inflation data, real wages, real hours worked, real investment. Real investment just means investing into things like machinery or anything that increases a company's productivity levels rather than taking the money and reinvesting it to buy back shares of its company, which sure makes it more valuable, but does nothing to invest in the actual company. It also looks at the 10-year inflation expectation survey, which is a measure to how we feel as consumers about the future of inflation, which matters a lot. And it looks at 10-year treasury bonds, as well as an amalgamation of all this data dating back to the 1960s to get its information. So it's pretty unofficially official. So here's what it's predicting now. With regards to inflation, it's predicting that we will finish the year with 3.8% inflation, which is actually a full percent more than their last prediction. But the most important thing they talked about is the odds of a recession, because right now the odds of a hard landing now stands at 80%. And that's defined by at least 2 quarters having back-to-back negative GDP growth. So at 8:30 a.m. on July 28th, they're predicting that we will have negative GDP growth, which is when we will officially be in a recession. They also predict that we will finish this year, 2022, with a negative 0.6% GDP. And that's in comparison to their last estimate, which is a positive growth of 0.9%. So we're definitely flipping directions. And unfortunately, next year for 2023, things are not looking much better because their prediction says that next year will probably finish with a negative 0.5% GDP. So very real chance that next year we could still be in a recession. So that's the unfortunate reality that the data is pointing to. So now let's talk about Bitcoin, because things are getting even crazier there. All right, so Bitcoin is now below its previous all-time high. And this puts in question the legendary stock-to-flow model, which a lot of people have relied on, which as of right now shows that Bitcoin should actually be $110,000, not 17 or 19 or whatever it's at right now. So what's going on? Why is Bitcoin worth so little if it's supposed to be a hedge against inflation? And we're seeing inflation right now. And is the model broken? And those are really good questions, and here's how I look at it. Please keep in mind, I'm not an economist, so I don't know what I'm talking about, but here's how I think about it. Quick refresher. The stock-to-flow model was something that was created to predict the future price of commodities like gold and silver, finite resources, right? So a guy by the name of Plan B took this model and retrospectively applied it to a finite resource like Bitcoin. And today we have this stock-to-flow model. Now, right now, Bitcoin is not where it should be, which puts in question whether it's accurate at all or not. And the reason that I think it's still accurate is because the stock-to-flow model only relates the stock, which is the amount of something in existence, in relation to its flow, which is the rate at which we create or produce something. That's all it does. It cannot take into consideration macroeconomic factors. And I would argue that right now, we're going through a black swan event that we could not have predicted. Just think about it for a second. We have a major conflict in Europe, which could last for a very long time and affect supply chains. We have sky-high rates of inflation setting 40-year record highs, and that means people have less discretionary income to keep for themselves. Less income means less to spend toward investing. And because inflation's high, we have to increase interest rates to cool the inflation down. But that also means that fixed income assets like bonds generate more income. And that becomes a lot more attractive than the risky stuff like Bitcoin, especially with dividend stocks that tend to do better in markets like this. We also have the collapse of Terra Luna, which makes people scared for how the government will regulate stablecoins. We have tech jobs disappearing, which makes people afraid for their own jobs. And we have general worries of a recession. So of course, people are not investing money in the markets when the economy itself is extremely risky. And that's why the stock-to-flow model just cannot take into account all these things. These variables are unpredictable. That's why I'm not worried that it's broken, because I don't think we live in a normal time. But I do have another worry, and here's what it is. Will Michael Saylor get margin called? Now, if you don't know who Michael Saylor is or why he's important to this story, Michael Saylor is the CEO of MicroStrategy, and his company owns over 129,000 Bitcoins at an average price point of $30,700. So right now, he is down more than $1.25 billion. So don't feel too bad if you lost a little bit of money with crypto, because he has lost more than we will ever be worth in our entire lifetimes combined. He took out a $2.2 billion loan to be able to buy those Bitcoins. And the concern is that if Bitcoin reaches a certain price point, that it would force him to get margin called, which is where his Bitcoins would be forcibly sold from under him without his choice. And that would be bad, because the market would not like having 130,000 Bitcoins flood the market for sale all at once. It would be catastrophic for the price and it would go down, which could subsequently potentially trigger other people who have taken on margin to sell their Bitcoins as well. Now, all of that is a good reason to pay close attention, but here's a few fun facts about his loan that you might not have known, which is the average interest rate was 1.8%. That's extremely low. And 1.7 of the 2.2 billion that he borrowed is unsecured debt. So the other 500 million that he owes will actually be paid 7 years after the loan was taken out. So he has time on his side. And because his company produces cash flow, chances are he'll be able to service that debt when the time comes. So it's still a calculated risk, and it is a gamble that maybe the market is aware of and it doesn't like, so that's why we're seeing some volatility. Now, price is not Bitcoin's biggest problem. Instead, here are 10 problems that Bitcoin's facing that I'm paying super close attention to. And this is directly from Michael Saylor himself. Number 1, Bitcoin has no wash sale trading rule, which means people can just sell their Bitcoin and buy it back again, and that's not the case with stocks. So once that loophole gets closed, Bitcoin's price will become more stable. Number 2, there are over 520 unregulated exchanges that offer 20x leverage, and that means Bitcoin's price is extremely sensitive to any movements. So once those exchanges become regulated and the leverage comes down, the more stable Bitcoin's price will be. Number 3, there are over 19,000 crypto coins out there that are interconnected and cross-collateralized with Bitcoin, and not all those projects play by the rules. So when some of the big ones especially collapse, it affects Bitcoin's price. So once we get more clarification on what these are and if they're securities or not, hopefully that will stabilize Bitcoin's price. Number 4, the DeFis of the world, the decentralized finance exchanges, and some of the CeFis that act as big banks can sometimes become unstable, especially when they freeze withdrawals, which affects Bitcoin's price. So as they become bigger and more mature and are regulated better, Bitcoin's price will become more stable. Now, number 5, there's no real stablecoin. Yes, we have USDC and Tether and Terra Luna, but those are not real stablecoins in the sense that it does not give the market confidence. Grandpa and grandma don't want to put their money in stablecoins because they don't know if it's going to lose 90% of its value overnight or not. So that's coming though with Fedcoin, right? The government's stablecoin, which will actually be super helpful in giving maturity to the space. Number 6, Bitcoin does not have a spot ETF, which means grandpa and grandma's IRA money, which is trillions and trillions of dollars, is something the crypto space does not have access to, unlike traditional assets do. And number 7, crypto does not have any insurance protection like banks do with the FDIC and dollars. Because if you were to bank with a bank that collapsed, you would be protected up to $500,000 in cash and stocks. If that was to disappear, you'd get your money back, but that is not the case with crypto-oriented businesses yet. Number 8, something called Fasb Accounting, which is an accounting standard for companies to disclose what they're investing in and what their holdings are, for which there are no standards for crypto and Bitcoin, which discourages companies from investing in Bitcoin because then it becomes an accounting nightmare. Number 9, we still need more clarification from the SEC and CFTC with regards to what securities are. And number 10, Bitcoin is still not ESG compliant. But with each passing year, Bitcoin becomes greener and more energy efficient, which becomes harder to criticize for being wasteful. So that right there are 10 reasons that have nothing to do with Bitcoin's price that's going to change the game in the next 5 to 10 years. But these problems are not going to work themselves out in the next few weeks or few months. This is going to take a while. That's why it's more important than ever that I dollar cost average into Bitcoin, because the 4-year moving average on Bitcoin is $21,685. So right now we are in a very rare but brief period of time where Bitcoin is trading at those levels. Now, I'm not trying to convince you to buy Bitcoin, I'm just explaining what's going on and sharing my perspective. The rest I will leave up to you. And as always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin with this link right here. Grab your free stocks, the links are down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday and Friday, sometimes a Wednesday. Bye-bye.